All right, good morning, everyone. Thank you for joining us for our webinar today on how to navigate EU sustainability legislation. This is Kellen Mahoney, the Director of Suppliers Partnership for the Environment, and we're so pleased to have you on the webinar this morning. Before we get started, I just want to cover a couple quick housekeeping items. So first, this webinar is being recorded, and we will be making a copy of the recording available to all of you after the fact. If you have questions for the panelists as we go through the presentation, please do use the Q&A window on the bottom of your screen to enter those, and we should have some time for Q&A discussion after the prepared presentations. We also will be conducting a few live polls during the webinar to help us, get a sense of the audience here and where there might be some opportunity for further follow-up and education around some of the topics we're discussing. I do want to highlight all these polls are fully anonymous, so we will not be collecting or able to see any individual responses, only the aggregate percentages in terms of how you all respond. So just wanted to make you aware of that, and there will be some opportunities for input, as we go throughout the presentation this morning. So just by way of a brief introduction before we get into the content here, for those who aren't familiar, Suppliers Partnership for the Environment is an industry trade organization based in Washington, D.C., that for the last 20 plus years now has provided a forum for automakers and their suppliers to come together to work pretty competitively toward shared environmental sustainability goals for the industry and for the broader environment. And where we sit today is really trying to provide a forum to promote more communication, more collaboration up and down the value chain, around those shared environmental sustainability goals to make tangible progress in the short term while aligning action around those long-term aspirations. And as we have had these conversations recently within some of our work streams around carbon neutrality, around EV battery management, around waste and circularity, the topic of EU regulations and some of the trends that we're seeing outside the North American region, moving from voluntary expectations to formal requirements and moving toward much more stringent data standards around sustainability has been certainly a topic of interest of many of our members. So really pleased this morning to have three expert partners from one of our member companies, Ricardo, who are deeply involved in this work, both with the European government and with companies in the European region around some of these regulations to share with us some of the things that they're seeing specifically related to sustainable battery regulations, the Corporate Sustainability Reporting Directive, and the Carbon Border Adjustment Mechanism. And so with that, I'd like to introduce our three panelists this morning. First, Sophia Amaral, Principal Consultant of Sustainable Transport, Jennifer Creek, Head of ESG Consulting, and Jamie Pitcairn, Technical Director of Corporate Sustainability for Ricardo. So Sophia, Jamie, Jennifer, welcome. Looking forward to hearing from you. And I will turn over to Sophia first to get us started.
Great. Thank you so much, Kellen, and thank you so much for the invitation to present to you today and share a bit more about our insights on EU sustainability legislation. Very happy to be joining you. So the plan for today, I'll start with a quick introduction. For those of you that don't know us, just to tell a little bit about Ricardo and what we do, and then I'll give you a brief overview of the European sustainability agenda. But then the focus of this webinar, as Kellen mentioned, is really to do a deep dive into three key sustainability policies in the EU. So I will cover the Sustainable Batteries Regulation, SBR, and then I'll hand over to my colleague Jen, who will cover the Corporate Sustainability Reporting Directive, CSRD, and then Jamie will cover the Carbon Border Adjustment Mechanism, CBAM. Okay, so for those of you that don't know us, so we're part of Ricardo. We're a global strategic environmental and engineering consulting company. We have over 100 years of experience working with the automotive sector, providing engineering support, strategic advice, and policy analysis. Today's topic is about policy, and policy is a core area of work for Ricardo. So we have extensive experience of working with policymakers across the world and also with, in particular, with the EU. So we have worked with the European Commission, with European Parliament, and other European Union bodies. We also use these policy insights to provide support and advice to our corporate clients, helping them understand upcoming trends, new regulatory requirements, and the impacts and implications for their industry. We combine these expertise with our extensive knowledge on other sustainability areas to help our clients identify the best sustainability solutions to help them meet these regulatory requirements, but also address any other challenges and ambitions they have in terms of sustainability. So we have teams dedicated at working on life cycle assessment, on circular economy, waste and resource management, ESG, among many others. So today we bring you a presentation on some of these insights that we have on policy, particularly looking at how policy is expected to evolve in Europe in terms of sustainability and what are the implications of that for the North American market. So let's get started then with an overview of the European sustainability agenda. So here the turning point is really the European Green Deal that was announced at the end of 2019. So the European Green Deal is the growth strategy of the European Union that aims to transform the EU into a carbon neutral and a resource efficient economy. So it sets a very ambitious vision for the EU, achieve carbon neutrality by 2050, but it also aims to tackle other environmental and social challenges that the EU faces. As you can imagine, these will require efforts from across the different sectors of the economy. And so with this in mind, the European Green Deal also sets the vision for a number of sectors. It has a vision for the transport sector, but also for the energy sector, for agriculture, for buildings, and for industry more generally. At the moment, all the 27 member states of the European Union have agreed on the 2050 target to achieve carbon neutrality by this date, but they've also agreed on the intermediate target for 2030 to reduce CO2 emissions by 55%. To be able to achieve this ambition, the European Commission, which is the legislative body of the European Union, has been revisiting and revising a lot of the policies, also developing new policies to align the incentives and to create new policy signals to help the economy achieve these targets. So a good example of these is the Fit for 55 package that you might have heard of. So the Fit for 55 package is a package of different policies which were proposed in July 2021, and which they aim to achieve the 55% reduction target. So there's a lot of change happening in terms of the policy landscape. So it was also recognized by the European Union that there was a lot of burden being placed on the industry, a lot of effort being required from the industry. And so more recently, they've announced the Net Zero Industry Act, which aims exactly at providing support and incentives to help the industry navigate this transition. So overall, really, the European Green Deal is setting the tone for sustainability in Europe, but also across the world, with having ripple effects across the world. This is because the European Green Deal involves a lot of policies that not only have an impact on companies that are based in the EU, but also on products that are sold in the EU market, regardless of where they were produced or where they originally were sourced. So a good example of some of these policies are the ones that we want to discuss with you today. So we bring you these three key sustainability policies that are quite relevant for the North American automotive sector. So I will cover the Sustainable Batteries Regulation, as I've mentioned. So if you are involved in battery production, or if you are involved in building a product that uses a battery, then it is possible that these will trigger some obligations under the SBR. If you have significant activity in the EU, then it is possible that this is triggering reporting obligations under CSRD. And also, or if you have, if you're exporting certain materials into the EU, then it is possible that you will have to start paying a tariff or the carbon price under CBAM. So we'll tell a little bit more about what each of these policies entails and how they might affect companies based in the US. So I will start with the Sustainable Batteries Regulation. So this is a very recent regulation. It was adopted in August this year, and it basically establishes a range of requirements and targets for all batteries that are placed or put into service in the EU market. It repeals an existing or replaces an existing legislation called the Battery Directive, and it has completely changed the policy landscape for batteries in Europe. I will tell you why in 3 points. So first of all, the new regulation has extended the requirements to more battery types and has created a specific category for EV batteries, which means there are dedicated requirements for EV batteries now in the new regulation. Second, the scope of the legislation has also been extended. So before it was more focused on end-of-life management of the battery, but now with the new rules, it covers the entire battery life cycle, which means it introduces requirements at the production stage, at the use stage, and also the disposal stage of the battery life cycle. And third, it has significantly increased the number of requirements and targets. So just to give you an overview, there are more than 90 provisions in the main regulation, but really this is just the beginning because we're expecting to see more than 40 legislative acts associated with this regulation to help implement some of these targets and requirements. So really there's a lot happening, and some of these requirements will start applying from August next year. Also wanted to tell you a little bit more about what are the type of requirements and the new requirements that we are seeing in these regulations. So the way we see it is that there are 4 main key areas of requirements, some of which, as I said, will start applying from August 2024. A key area of requirements is the sustainability and safety requirements. So the new rules double down on restrictions in terms of the use of harmful substances in batteries, but they also introduced new requirements to provide more information on the carbon footprint and the recycled content in batteries. Not only these requirements require the provision of these information, but they will also introduce targets. So at some point in time, companies will need to start demonstrating that they are reducing the carbon footprint of batteries and they are increasing the use of recycled materials in batteries. Another very important element in the new rules is to do with the labeling and information. So it's very important in these new rules, the transparency of this information. So we see more requirements around the use of digital tools to communicate this information. And a good example of that is the use of the digital battery passport, which will need to accompany the battery over its entire lifetime. Another important area of requirements is related to supply chain management. So we're seeing additional requirements on the need to have a due diligence policy in place, the need to monitor, but also manage and minimize risks from the supply chain. And these due diligence policy will need to be verified by a third party. And then finally, we have a continuation from existing requirements on the management of waste batteries, but there are some new requirements around targets for recycling and recovery of key materials used in batteries to ensure better, that batteries are built with circularity in mind. So this is just a quick overview of some of the key requirements that will enter into force very soon. And as you can imagine, with such a range of requirements covering the entire life cycle of the battery, there will be more responsibilities across the battery value chain. So here, as one would expect, the manufacturer will be a key player, and the regulation says that the manufacturer of the battery is responsible for ensuring conformity with the new rules. However, the situation is a bit more complex than that, because actually the responsibility of the manufacturer might actually lie with the importer or the distributor of the battery, because here what matters in terms of the regulation is how the battery enters the EU market. So the regulation mentions concepts such as placing the battery in the EU market or putting the battery into service for the first time in the EU market. So the organization that's responsible for these activities are the ones that will have a lot more responsibility and will need to comply with many of the requirements. So just to give you two examples, if the battery is produced in the EU, and this is the organization that places the battery in the EU market, then these would be the manufacturer, and they would be responsible for conformity. However, if the battery is produced outside the EU, then we need to see who is the organization that is placing the battery in the EU market, and that would be the organization that would be responsible for conformity. Then we need to continue to monitor responsibility across the lifetime of the battery. So it is possible actually that responsibility exchange hands between organizations. For example, if there is a need to significantly remanufacture the battery, or if it's repurposed, then it is possible that another organization becomes responsible for the battery. And then at the end of life, we need to have a look at who is the producer. So the producer, again, can be the manufacturer, the importer, or the distributor. So it'll be important again to see how the battery entered into the EU market, whether there was a transfer of responsibility for some of the requirements, to then be able to determine who the producer is. So really compliance will be an evolving activity, not just in terms of understanding the share of responsibilities, but also in terms of the new requirements. The targets and requirements will be phased in. So some of the first ones will start already next year, but others will only come into force later on. The timeline that you see on the slide here just shows some of the requirements, some of the most important requirements. And you can already see that some of the requirements will increase in stringency over time. So for example, if we look at 2025, we have the requirement to provide information on carbon footprint. But then by 2028, there is a new requirement to meet a maximum carbon footprint threshold. So there will be an obligation here to start reducing carbon emissions from batteries. The same with the recycled content. First, the requirement is to provide information, and then there will be requirements on minimum levels of recycled content, which actually also increase over time. So just to finalize, I'll leave you with some suggestions on how to prepare for these very complex but very interesting piece of legislation. So what we in discussions with some of our clients as well, what we tend to advise is the need to really understand what are the key requirements and targets for your organization. This depends on the type of batteries, the responsibility, the role you play in the battery value chain, to then be able to identify what are the priority actions, what are some of the risks, but also to be able to take advantage of some of the opportunities. Then you'd be ready to develop a strategy to align your organization with the new legislation. And here, what we also advise is to take into account the national context. So although it's EU regulation, it will be monitored by by all 27 member states. And so understanding who are the right authorities and players in this space is also very important. And then finally, you will need a range of solutions to be able to meet the requirements. So I've mentioned a number of sustainability areas that are targeted by this regulation. So you will need approaches and tools such as life cycle assessments and social life cycle assessments, understanding of recycling methods and facilities. So there will be a combination of solutions. And what we recommend our clients is to understand whether that's something you can do in-house or whether it's something that you need to look outside for the support. So yeah, so I think I will leave you with this on the in terms of the sustainable battery regulation. And just to conclude, as Kellen mentioned at the start, we've prepared a poll. So the question here for you today is, how prepared is your organization for the SBR?
Excellent. Thank you, Sophia. So we've just launched that poll. And again, I'll remind everybody that the response is completely anonymous. But while we give everybody a moment to respond, Sophia, there's a question that came in, maybe just as a quick clarification. So the question is, are the EV battery rules for automobiles only, or do they also include medium duty and heavy duty trucks?
All EV batteries, yeah, for all types of vehicles, yeah.
Okay, excellent. And there's also a second quick clarification here, where someone's asking for second life batteries, the responsibility will transfer to the manufacturer of the second life battery. Is that correct?
I think this is, I don't want to say without looking at the specific case. I think in theory, yes, there could be an exchange of responsibility, but we would need to look into the specific scenario because it is quite complex and there will be some requirements that transfer responsibility and others don't.
Okay, great. And so I'll go ahead and share the results of the poll here. And I think everybody should be able to see that on the screen. It looks like, maybe more than half of the audience is not quite sure yet where they sit in terms of the regulation. But those that have looked at it maybe are fairly early in their journey. Does that surprise you in any way, or is that similar to what you're seeing?
I think so, because this is quite a new regulation and it's a bit unclear still to what extent it will affect the automotive sector and other segments of the industry, really, because there will be some requirements that will be directly relevant to some organizations, but others will just be feeling some of the effects because for example, suppliers will need to provide more information to the automotive OEMs. So there's a bit of confusion. This is what we see in terms of who is actually responsible and who will need to take action.
Great. Well, thank you. And I know there's some additional questions, but we'll come back to those hopefully at the end. So with that, I would turn over to Jennifer Creek.
Thank you.
Thank you very much. Lovely to be here today as well. Thank you. So my section is going to be on the Corporate Sustainability Reporting Directive. So just to give you a bit of high-level background on what that is, the Corporate Sustainability Reporting Directive. Well, it's probably one of the most significant pieces of reporting legislation that has come forward in the last few years. But it entered into force actually this year on the 5th of January. Importantly, it's not a new piece of legislation in the context that it's replacing an existing directive, which is the non-financial reporting directive, which impacts currently large European companies with over 500 employees. One of the significant differences this time with this new Corporate Sustainability Reporting Directive is it expands the scope to a significant amount of other companies outside of the European Union. So about 10,000 companies are currently impacted that are non-EU based companies headquartered. So, and this is actually mandatory now for those 10,000 that will have to fall now in scope of the CSRD. So if you have any large subsidiaries that are within scope within the European Union, that you're likely to fall within scope of the CSRD. Within the legal text, it does refer to non-EU parent companies as third countries as well. So, so that's the terminology typically used if any of you are familiar with the regulation to date at the moment. One of the other parts of this, with translating from the non-financial reporting directive to this new corporate sustainability reporting directive, it not only extends out the scope of companies that fall within requirements for this, but it also is much more prescriptive than the former directive. So in the past, large European companies had a little bit more autonomy to use other standards like the GRI and others to, so that's the Global Reporting Index, to inform how they might structure some of their reporting. This new requirement requires actually companies to disclose in accordance with their management report of their annual filings. And it also requires a mandatory requirement to use a concept called double materiality. Typically in the US, you'll be looking at financial materiality through the US Securities Exchange Commission. And if you're voluntary reporting on sustainability, you might approach it from an impact materiality assessment view. So double materiality fuses both that financial materiality, so looking at issues, non-financial issues like climate or environmental or social issues and the impacts you have on the enterprise value, versus the view of impact materiality, which looks at the company itself and the impact it has on the environment and society around you. So that later piece, the impact materiality, is really that multi-stakeholder view versus more an investor view, looking at the revenue and the impact actually on your company. So this is actually the first time that globally that this concept has been actually hardwired now into legislation. So these two concepts are still developing and evolving as this piece of legislation develops as well. And that's something we'll jump straight into to talk a little bit about further later, of how companies are really approaching this, particularly companies outside of Europe who are already regulated by financial materiality focus. In addition to doing this double materiality or using this approach when thinking about what material issues to actually report in your annual report on non-financial material matters, the European Union has been very prescriptive, and for the first time actually globally now sustainability reporting standards are now mandated into the regulations. So quite often you'll hear about the CSRD regulations or the directive, but it's actually the European Sustainability Reporting Standards that are the core feature, which are an appendix to that, which will really inform around what you need to report out on. So the CSRD regulation itself is more around sort of the scope, who's in scope, what are the actions, but it's the appendices that are around the, today I'll call it the ESRS, that's an acronym that we've spelt out just now, but so the ESRS are really the fundamental piece of this, in line with the double materiality as well. So not only is it really a double materiality, so that new concept, it's looking at these new mandates of these standards, so the output, the materiality will inform the standards you have to report against. But all of this, because it goes into the annual filings, will also have to be assured with external auditing. So there is a time period where companies will be required to do sort of limited assurance, extending out for the future as well. So for non-EU parent companies, which we've focused on today, since that's the focus audience, we've created this flow chart to really help you navigate where you potentially might sit within scope of this CSRD. So on the right-hand side, you can actually see a yellow box, which is really the general scoping for EU-based companies. So today, for next year, many European companies that are already required to report against the non-financial reporting directive will be collecting data to report out in 2025. Now, if European companies aren't currently covered under the non-financial reporting directive, i.e. they were too small, less than 500 employees, then they will fall under the scope of a large company, which is bullet 2 in the yellow box. And similarly, SMEs will also be drawn into the scope of the CSRD over time. Just recently, a draft guidance has been set also for small, medium-sized enterprises on how they may comply with this new directive as well. So important to know that these are the general scoping guidelines for European-based companies, but also subsidiaries. So as we go through this review, it'd be also to think about your companies and where you might have a predominant subsidiary that might fit the scope of the directive. So As a non-EU based headquartered company, the first question is really around, does the consolidated group generate a net turnover of over 150 million in the EU? And if you've done this for the last 2 consecutive years, you then go through to the next question, which is really around, do you have more than one EU subsidiary that would meet the general scoping in the yellow box for these large and EU listed thresholds? If the answer is yes, then it's more than likely that your parent company in the US will fall under scope, with the first report against this reporting out in 2029 for the financial year 2028. But bearing in mind, for that large EU subsidiary, you will likely have to report in the earlier years, and that will mean that you fall under bullet 2 in the yellow box, that you'll have to report in the financial year 2025 for reporting out in 2026. If the answer was no, that you don't have a subsidiary, but you do have a branch or more than one branch that's generated a net turnover of more than 40, you will also fall within scope if the answer is yes to that. This may seem a simple flowchart, or maybe not, but in reality, it can be quite complex when you're actually, so it is we always advise for you to speak with your legal department and financial groups to really break down your financial structure of how you're currently reporting today, because it's not a black and white case for every company that we find. So really it is about understanding that, and then that can help inform your strategy on how your approach is to how you comply with this over time. So quite often we get a lot of questions, particularly from the non-EU parent companies that we work with in the US, around the definition of materiality. And there's been quite a lot of debate in the world of practitioners on sustainability around this topic, because traditionally companies have been voluntary reporting on sustainability, and allowed allowed to use the voluntary standards. So for example, the GRI, the Global Reporting Index, is the gold standard today for most sustainability practitioners to report on sustainability topics, and also the impacts of those. That's an internationally recognized standard, and that standard body is also talking with the European Union, luckily. But in that approach, many companies are using that definition around materiality. I think when we move to more mandatory requirements, so not just voluntary, but integrating this now into the financial accounting, that's when the waters get a bit more muddied on who's this information really usable for and is going to be used by. And essentially, it's the investors. For most jurisdictions, it's really centered around the investors. So the IFRS, which is the International Financial Reporting Standards, they've now released a couple of new sustainability standards. They've integrated the SASB, which was started in the US. So the Sustainability Accounting Standards Board now sits under the IFRS. And those are the sector-specific guidance, key KPIs that you as an industry should be reporting out on as well. But they also have a different focus on materiality. It really is on the financial materiality. So what information is material for that investor decisions going forward. And then obviously the US SEC also have a very similar kind of materiality focus on financial materiality. But the European Union is an outlier, I guess, in trying to really fuse both of these views. And I think one of the important takeaways to have of this is that the financial materiality is critical to make really strong decisions as a business in the near term, but also long term on what is actually really going to hit your bottom line. But what the multi-stakeholder view can have a really support vision and strategy as a company on is really giving you that firm view in the future of what potentially could be financial material, and thinking about the broad stakeholders you interact with as well on a daily basis, but also where you might have future revenue from as well, is really critical to integrate that into the process as well. So by doing this double materiality assessment and fusing these 2 different views actually can give you a much more rich outlook and strategy as a company going forward. But throughout this process, how we advise is, let's not create something new. Let's look at how these definitions work within a company and how you respond to them currently. And let's use those processes to build on that to actually formulate a plan on how we will respond to double materiality. So I'll just go to the next slide, sorry. So I mentioned these standards, and they're incredibly important because these are very prescriptive standards. So you'll have to, the output of the double materiality assessment will inform what you need to report out on the standards. What you can see here on the screen is the breakdown of, in yellow, the 10 sector agnostic standards, which you'd have to report out on based on the materiality output, and then one general requirement, and then ESRS 2 is a general disclosure, which has some additional information to report out on as well. Although these may seem like new standards or very daunting to look at all of these and think about which ones would be most material to your company, if you are already on the journey of voluntary sustainability reporting and using the GRI or even the SASB, the Sustainability Accounting Board, which is now under the IFRS, or even you're looking at the Task Force for Climate-Related Disclosure, you're already working to some degree on closing some of those gaps. So it's worth looking at your voluntary reporting and really mapping against these standards to really understand where you sit today regarding maturity. And just a quick flash up really here. So again, I was thinking about the sector as a whole. And these are on the right-hand side and left-hand side, you can see some kind of key big topics. These are kind of key trends that we quite often are seeing across the industry, across the automotive sector. And these are, I've just linked a few here so you can see really how they link back to some of the standards. Many of the standards have common things that you're working on today. So again, it's really about thinking about what your business needs are, where your strategy is today, and thinking of them in these thematic areas here. Again, not starting from you, but really being aware of the what you have today and how to build on that for the future. And then what's the legal basis of these European sustainability standards? Well, it's really important to be aware that the standards are actually part of the annexes of the CSRD. So they are legally binding now. This is different from other standards which don't have that legal connotation. So the CSRD and the ESRS standards are really intertwined as one legal package, but important to be aware that there are several other regulations that link into this. So the CSRD really is that platform for getting companies to report in on other frameworks as well and regulations. So really this is the vehicle to actually complying with many other regulations. So on the right-hand side, you'll see the Sustainable Finance Disclosure Regulations. So this is a financial regulation that many investors have to now sustainability report on. And this includes a significant amount of KPIs that they require of companies to report out for the EU Sustainable Finance Disclosure Regs. So again, this is a vehicle for them to collect that data and be able to get that in a unified and standardized manner from companies. The EU taxonomy is a green classification system, which essentially requires, is of another financial regulation, but supports the investors and market financial participants to report out on what portfolio of their products are EU taxonomy aligned or eligible. And similarly, companies also through the CSRD will have to be required to talk about what turnover, CapEx and OpEx is aligned with the taxonomy. And then finally, the Corporate Sustainability Due Diligence Directive. This is a significant piece of regulation that's still in development. It will be finalised hopefully early next year. And this will require companies and non-EU based companies under the CSRD to report on environmental and human rights due diligence across the value chain. So again, important to be aware of these other pieces of regulations and how they link into the CSRD. Oops. So taking a step back, that's quite a lot of information to share of different things that are happening and how this all lays out. But key steps that we work through with companies quite a bit. These are the key steps that we go through typically with a client that we're working with. So So first of all, we always advise to start with the context and scope, as we've mentioned before, really working internally as well with your finance departments and the legal groups, really to understand which of your entities fall in scope. But also you can work on, just understanding your current state. What's your maturity with regard to current voluntary reporting? And also, you may already be filing some of this information nationally also with some of your subsidiaries. So understanding what your subsidiaries are also reporting out on as well would be really important. This then helps them frame up then to go into a double materiality assessment, which really helps you then look at your stakeholders and refreshing your mapping against who are the most important stakeholders and engaging with those. To then identify the impacts, so the impact materiality, as well as your financial risks and opportunities. And then the output of this will then inform a gap assessment, which you'd be doing against this ESRS, which would then inform a roadmap, and then your governance processes and controls. Now, I would say that governance is also important at the start. We often are talking with boards on behalf of our clients to really inform them and bring them on from the start. I think making sure that at the highest level that you have commitment and understanding of the breadth and depth of what you need to include is really critical. And then all of this really helps then with the auditability of the work as well, which will come at a later stage. So I thought I'd just focus on a couple of visuals to show you what an output might look like of those first three. So first of all, context and scope. When you're thinking about discussions with your board and drawing them into what the impacts really are for your company and where your current disclosure requirements are and status is at the moment, having a kind of snapshot view, such as this one here, can actually help you just have that conversation with senior executives. So this is actually something that we've been working on conceptually with clients at the moment to help think about those different standards and also where you sit today with regard to your current disclosures. And by having this sort of snapshot allows you to really have those really early discussions with senior management before you then go into the double materiality. This visual actually shares an example of a client double materiality matrix, which we often do for clients. But equally, you can have a table where you display all the different impacts and provide different context there. So it really is up to your discretion how you want to present this information. The regulations actually don't require you to do it in any specific way. It's more around sort of how you think as an organisation you should represent this. And then finally, this is again another sort of visualization representation of when you do the deep dive. So once you've identified what's material for your company, this is an example of the climate change one where you deeper dive into the standard itself, and an output of that could be just a very simple graphic like this, which again can be really informative for discussions internally of where your key gaps are and where you need to make improvements. And then finally, one of the things we did do is just do a quick review of some of the members and where they're currently stood with regard to materiality assessments publicly that you put in the public domain. So the members that we found who were already publicly disclosing an impact materiality assessment, with that being a matrix or a table, that was 13% of the members. But the members that did not disclose fully through a matrix form or table their impact materiality, there was about 87 members. And only one of the members we could find actually publicly reported on double materiality currently. So there's obviously a huge area of opportunity as well to support clients, not only on the financial materiality focus, but also on the impact materiality going forward. And that leads me into the next poll, actually. So I'll just flip onto that slide.
Excellent. Thank you, Jennifer. So I'll launch that poll here now. And while we're doing that, there's a question that came in here, maybe as a quick clarification. Could you state, the estimated number of U.S. companies that might be subject to CSRD reporting? Is there an estimate there in terms of what that number might be?
Yeah, I think the recent research suggests about 10,000 companies fall within within scope of non-EU based, and a large proportion of those are US based.
Excellent. Thank you. All right. Give just another second here on the poll before we share the results. And, it looks like from the responses coming in here, there may be a trend where, a good portion of the respondents, are not quite sure, where they sit, but those that are, still fairly early, right, in their maturity or in their process here, which I think, as you stated, with all of this being quite new, perhaps makes some sense.
Yeah, definitely. I think I think it sometimes these assessments can also be within internal companies, often done in certain departments, and not necessarily integrated as well throughout the organization. So so that's also one of the challenges, but also one of the opportunities, that really bringing the right people together to really talk this through can actually really start to step change also the way you look at issues. And I see this really as a way to forecast emerging issues as well for the future. So to help with prioritization of current issues, but also emerging issues, either through an investor lens or through multi-stakeholders. So it shouldn't be a tick boxing exercise just for the CSRD. It really should be part of your strategic planning and thinking. So I do encourage everyone to start on that journey early, not just for CSRD. So.
Excellent. Well, thank you, Jen. And so from here, I think we'll turn over to Jamie, who will talk about CBAM. So, Jamie.
Excellent. Thank you very much, Kellen. Yes, so another example of a piece of regulation that's coming through the European Green Deal. And I think it's safe to say that the European Commission has been very busy over the last couple of years in developing these policies. So this is the third one of the EU regulations we wanted to talk to the members today. But there are others. There's lots more coming down the track. So it just shows, just how sort of focused the European Commission has been in developing these regulations to help it meet its commitments on carbon. So it does not just impact the EU, as Sophia said. This has a ripple effect across the world, and we're starting to see huge interest in organizations that really need to understand the impacts of these EU regulations on their businesses and their business models. Just in terms of a bit of context here, the CBAM is very new, as are these other regulations, but the CBAM is the very, very new, only being adopted in August of this year. And it's here really is a transition phase. Because it is new, there is a transition phase. We'll come on to that later on. And this transition phase is essentially there to create a bit of a soft landing. They want to give themselves some space, the European Commission, that is, to develop the systems, the platforms, the procedures. They also want the reporting businesses to have some time to develop the data, to understand the impacts, and to start to engage with their supply chain to pull that data together. So there is this transition phase, which is designed to allow just a gradual process before it then ramps up later on, as we'll find out through 26, 27, 28. So I'm trying to keep this sort of really, really simple in terms of a graphic, just to explain what the carbon border adjustment mechanism is. But if you see on the left-hand side here, let's just say this is conventional process within the EU, where we operate under an energy trading scheme. Within that trading scheme, if you're a manufacturing business, you will be subject to a carbon tax. And at the minute, that's circa $75 per ton of carbon. So in essence, that is putting EU businesses at a disadvantage, a competitive disadvantage, because for every unit of product they produce, they will be subject to this tax. And whereas in other jurisdictions, in other regions, they haven't got such a heavy penalty on carbon tax. So what is happening, what the CBAM is trying to do, is to then reduce that disadvantage to the European Union organizations. So essentially, if you're a third country, if you're a country out of the EU, placing product onto the EU, then you will be subject to an additional tax to level that playing field, if you like. So the example here is, if you are operating in a country where you have, say, $10 of tax per ton just through your energy bills or through some fiscal process, then what would happen is to try and level that playing field, you would be subject to a carbon tax of €65 per tonne of carbon that you're emitting. Safe to say, though, that any financial payments wouldn't be kicking in until 2026. So this is part of this transition phase where the payments wouldn't actually start to happen until 2026. It's also a recommendation of ours that you are looking very closely at your domestic internal situation. So trying to identify areas where perhaps you are paying a carbon tax. It may be a little bit hidden in terms of some of your bills or some of the payments that you make. So having a good look at some of those fiscal arrangements in your country, it may mean that you're not subject to the full cost, the sort of the parity cost of the €75 per tonne. So just in terms of the objectives, I mean, I've listed them here, and there was a question about sharing the slides. We will be sharing all of these slides. So when there are a few words on these slides, I don't intend to go through them verbatim. We will share them, but I'll just tease out the key points here. And as I mentioned earlier, the CBAM is designed to create a level playing field. That's its intention. It's to promote equal opportunities between EU companies and our trading partners, but it's also to prevent carbon leakage. What we don't want to see from a global perspective is that organizations are just leaving a jurisdiction that's maybe setting some leading carbon policies and are then establishing themselves in countries where there is perhaps a weaker regulatory environment in terms of carbon and sustainability. That's not what we want. So to try and protect that, they will then create this carbon tax for organizations that are operating out with a jurisdiction that doesn't have a strong environmental fiscal arrangement. It's also trying to protect those companies that have already invested in green technologies. And again, that's coming at this competitive advantage. If you're investing more in energy efficiency and low carbon manufacturing technologies, then it is going to cost you more per unit of production. So that is deemed unfair in a global perspective if that's putting you at a disadvantage to others who perhaps aren't investing in and utilizing that capital investment. It is also trying to encourage other countries to deploy similar sort of leading carbon policies. So as an example, if you're, let's say, US government and your company, you know that your companies are paying a tax into the EU, you would far rather that you were taking that tax within the US as opposed to giving that money to another jurisdiction. So in essence, what the EU Carbon Border Adjustment Mechanism is trying to do is to encourage other countries to set similar types of carbon tax to try and level that playing field. And I'm sure the US government would far rather they had access to that money as opposed to the European Union having access to that money. And of course, this is a revenue generation. So the EU is implementing this, so it will get some income, and then so it can recycle that income into decarbonising the grid and into supporting its companies and member states to reduce their emissions. So in terms of coverage, reasonably straightforward. The only point here is that it's limited coverage at the minute, and the reason it's limited coverage is that these are deemed to be the sectors or the products that are deemed to be of the greatest risk from carbon leakage. So they did want to protect these sectors and these products first. It's also worth saying that these are also the products or the sectors where it's quite easy to measure the carbon. So they wanted to make life easier for themselves in the beginning, but rest assured, more products, more sectors will be added over time. So they've tried to limit the coverage at the minute, both in terms of sectoral coverage and types of gases, but these will ramp up in due course. Interesting for, say, iron and steel, because it's not just the raw materials themselves that are being imported, it will be components that are made of these raw materials. So, for example, if you're looking at steel, then you can be looking at screws, at bolts, at tubes, at pipes, at axles, at whatever that may be. So there will be, significant products that are predominantly made from these materials. They will be in scope. And what's happening is that you're following the normal CN codes. You would have to check from your customs and your import information what CN codes your products are classified are, because if those CN codes are in scope, then obviously your products would be in scope. So in terms of the implementation timeline, I did mention there that there is a transition period. It's really important to mention that transition period, because in this transition period, it's trying to create a soft landing. There is a sort of a reduction in terms of the scope and the sort of strictness, if you like, of the reporting and the data requirements. So in this transition period, the CBAM obligations are restricted to reporting. So as I mentioned, you wouldn't be expected to pay any tax at this stage. This is about getting your house in order, getting your data aligned, and also giving that time to the European Commission and the member states to also get their internal systems and processes in place. The first reporting obligation will be in January 24. As we move into the definitive period in January 2026, then that's when the payments will start, and also the use of default values, which I'll come on to in a minute. The transition period will be split into two distinct phases. So for phase one, which is at the end of 2024, there is some flexibility. And for the second phase, they are starting to be much more robust in terms of the data that they require. So just to give that a little bit more detail here. So for the transition period, the obligation will be reporting obligations only, so no payment. You can see in the definitive period, you'll start to have payments being made. From the registry, that's the organization that will collect the information. There will be a transition registry set up that will move to become a definitive registry in 2026. It will be the reporting declarant, which could be a customs agent, which could be another import organization that you use. But as we move forward, there has then to be an authorized declarant. So they're trying to make it a little bit easier for organizations where they're able to use agents and third parties to declare. But later on, there will have to be that authorized declarant. For the reporting, as I mentioned earlier, there will be some flexibility. So for year one, the companies will have a choice of the reporting. They will be able to use the new EU methodology to report. That's still in development, I should say, and there will be some tweaks to that, but they are developing that methodology. You will be able to use equivalent third country national systems. By that, it means you will be able to use local domestic grid emission factors to help you with your reporting that may fall out of the more stricter EU definitions of that, and you may be able to use reference values, so globally available carbon emission data for certain products to ease your reporting burden in the first year. But as we move into the second year of the transition period, it becomes much more prescriptive, and you will then have to either use the EU method of calculating the emissions, or you will be using default values. And just to give a little bit more information on default values, and again, the idea here is that the Commission is not wanting to make life easier, or at least provide an easier way of reporting, or a way of reducing some of the fiscal burden. Some definitions here, but in essence, what the European Commission will be doing will be using the worst performing organizations or sites to define those default values. So if you are using the default values in years 2 or 3, you will be paying more. And so there is a real encouragement now that you start to get your data in your supply chains, data from your supply chains and your suppliers captured, and trying to find a way in which you can use that methodology to report, because in the long run, that will be much cheaper for you. During the transition period, your importers will need to become a CBAM reporting declarant, or use a third party to be able to do that for you, and you'll have to set up an account with the European Commission. You'll have to submit a CBAM report, which I'll come on to in a minute in terms of a little bit more detail, and that will be captured and sent to the transition registry. And the deadline of that report will be 1 month after the first quarter. The first quarter will be at the end of December of this year. So, it is new, but it is moving quite quickly. There is a transition period, but you still have a mandatory requirement to submit that first report. So just an overview here of some of the data that's to be required. So obviously your name and your CARB, your CBAM account number, but the data on imported goods is the important one. So you'll have to provide the type and quantity of each type of goods per production installed at the country of origin, and any embedded emissions. And I will come on to the embedded emissions because it is slightly different depending on the complexity of the product. and then information about the carbon prices to be paid, and a verification report. So again, you have to have your carbon data verified to be able to submit it. So in terms of the in scope, I hope everybody is familiar with the sort of scopes 1, 2, and 3. So for your products that you are importing, you would have to report your scope 1 and scope 2. So your scope 1 direct emissions, scope 2 indirect emissions. And this is from the last manufacturing facility at point of export, if you like, if you're talking about a North American country. So that facility that is the final facility, manufacturing facility for that product before it goes to export. But if you are using a product that has indirect emissions, so scope 3 emissions and indirect emissions from precursor materials, then you would have to provide the embodied emissions of that precursor material. So just as an example, precursor materials are the raw materials used in production of complex CBAM products like cement or steel, for example. Now, if it's cement, then it could be the clinker. If it's steel, then it could be the raw material in the steel manufacturing process. If you do buy steel to make your steel products, then you would have to include the embedded emissions of that steel. So if you're buying a steel rod, if you're buying a steel ingot, you would then have to seek the carbon emissions of that steel product. And this is where you could use reference emissions, if you like, at the beginning. If you don't have the actual data, you wouldn't be able to use those reference emissions. You would then have to use the EU's default calculations for those emissions, which you don't want to do because they will be the worst performing. So it's very much in your best interests to start to get that actual data from your supplier. So in terms of management, just sort of quickly here, the Commission will act as the central administrator and maintain the transition registry. So they will take all of the information, the certificates you're holding and assess that centrally. The member states will be responsible for collecting the revenues. So again, it's a bit of an administrative burden here, but if you're importing materials or goods into 3 or 4 different member states in the European Union, you will then have to set up payment mechanisms individually to each of those member states. So each member state will collect the revenues for the facilities that's receiving that information. And from your declarant's perspective, then the responsibility for you will be on the reporting and the capturing of those trading certificates. So the key takeaways, I think, from this session, this isn't meant to be too much information. It's just really as a high level overview for you. But just to summarize some of the key takeaways, this will add cost and complexity to any business. They have tried to reduce that cost and complexity by making it as integrated as possible into existing customs and export processes. But as I say, you will now have to capture and capture some of this carbon data, so it will add complexity. The transition period provides an opportunity to engage, through trade associations or sector associations to try and feed in views and feedbacks through this process. So I would encourage you to use that mechanism in that loop to try and make the system as streamlined as possible as the process matures over time. It will develop and expand, so they have got limited numbers of sectors involved in scope at the minute, but you will start to see that list of sectors and materials increase over time. So keeping an eye on the regulations and the policies as we go forward is really important. And the Commission continues to release a range of resources, so it's always worth keeping a close eye on the guidance. This is very new, things are changing quite quickly. So the EU methodology for calculating emissions and things, that will be issued, in the coming sort of weeks, months, and will likely be updated. So it is very important that you do keep abreast of these new developments and new guidance as they are released. Some no regret actions that you can take now. Just check my time, so we are running over. It's about getting your data in order, to be honest, and identifying the internal stakeholders that are important for your organization. This would be procurement, your supply chain individuals, and making sure that they are across these regulations, that you have the internal processes and procedures in place to help you do this. We recommend maybe just doing a snapshot, just doing maybe one product at a time, understanding where that data implications are and building that picture up in your internal systems and procedures, and then expanding that to other products that may be in scope in due course. So just trying to give yourself a phased introduction to that, I think, is really important. We have got, and we'll share these slides, we have got information on the Ricardo's website. So these are some links here to an FAQs and also to an impact assessment piece of work that you can help identify what the impacts to your organization would be. These are freely available, so please do use them and have a look. I'm very conscious of time, so I will just move on. I think we've got the final poll, Callan.
Yeah, and thank you, Jamie. And I think maybe in the interest of time, we can skip this poll and anticipate with this being new, like the others. I expect many people are just getting started. So Jamie, if you'd like to speak to this final slide here, and then we'll begin to wrap this up.
Absolutely. It's really interesting with these new regulations that are coming, as you say, they are very new. It's creating a burden on businesses. I think there's no way of getting around that. This is going to require additional reporting, additional studies to be conducted. We are not new to this because we've been operating in the UK and the EU for over 30 years, providing support to these businesses in the policy development. We have a range of skills and expertise to be able to help businesses. So if there are businesses there that do want some help, we provide a range of services we're seeing here, from carbon, scope 1, 2, 3 reporting, product life cycle assessment. We are able to help, and obviously with these policies, Sophia mentioned in the sustainable transport team, they are very, very close to the policy development from the Commission. So for example, it was colleagues of Sophia's in our climate policy team that have been working with the European Commission for the last year and a half in developing the CBAM guidance. So we are intimately linked, if you like, to that policy and that guidance. So that means that we are very well placed to provide that guidance to clients if they would require it. So just a little mention that yes, we are very happy to have some conversations after this if businesses would want. And if I move to the next slide, we will have our contact details here from each of the 3 speakers. And if you'd like any information on some of this freely available information we have, then please do get in touch.
Excellent. Well, thank you so much, Jamie, Sophia, and Jennifer. This is really helpful information. I know we covered a lot of territory today, and I think there's still much more to discuss. So I would say for those on the line, if there are additional questions that we don't have time to get into today, or if there's additional topics that you'd like to see covered in more detail around some of these regulations, as well as some of the other European regulations that we didn't get a chance to touch on today, please do reach out, and we'd be happy to work on follow-up presentations around this. But I think with that, in the interest of time, we will close this here for this morning, and just thank you again to the Ricardo team for your support, and we'll look forward to continuing this conversation. So thank you, everyone, and have a great rest of your day.
You're very welcome. Thank you very much, Kellen.
Thank you.
Thank you very much. Bye-bye.